And now it gives me great pleasure to welcome Dr. Trevor Polischuk.
Well, thanks, Mark. I appreciate that wonderful introduction, and hello, everyone. Good evening to you and good afternoon from my office in New York City currently, where I'm chatting with you today. Next slide, please. I am one of the co-portfolio managers of the Worldwide Healthcare Trust, along with the managing partner of Orbimed, which is Sven Borho, pictured here with me. For those of you who maybe don't know me, I've been part of Orbimed now for over 18 years. I do have a background in life sciences with a PhD in neuropharmacology. And I started my career in the pharmaceutical industry. I also worked as a sell-side analyst for a number of years in equity research at a large investment bank. At Orbimed, I effectively wear two different hats. First and foremost, I'm an analyst. I am responsible for all of our investments in large cap pharmaceutical stocks across all funds on a global basis, as well as all of our investments in Japan pharmaceutical companies across all funds. And of course, the second role is as co-PM of the Worldwide Healthcare Trust, as we've already mentioned. Next slide, please. In my presentation today, I will try and cover off multiple topics by telling you why you should be investing in healthcare today, review the performance of the Worldwide Healthcare Trust, discuss a little bit of the investment outlook for the rest of 2021, and give you a brief overview of the Trust's current portfolio and a little bit of the positioning within the funds. But first, if I may, on the next slide, a little bit of an introduction to Orbimed for those who may be unfamiliar with our organization. We are the largest dedicated healthcare investment firm in the world. I keep waiting for compliance to tell me to stop saying that, but they still allow me to say that, so I assume it is true. But we are very proud of that because everything we do here at Orbimed is healthcare. We have a very strong track record of returns spanning nearly 30 years now. Our footprint is truly global in nature. And as I said, we're 100% dedicated to healthcare across all cap structures and subsectors, from biotechnology to medical devices, pharmaceuticals, diagnostics, services, and pretty much everything in between. We're very proud of our team. We've grown throughout this pandemic, and we have over 30 colleagues now with advanced clinical degrees. Next slide, please. As an organization, we've recently surpassed the $20 billion mark for assets under management. And as you can see here, the split is roughly 1/3 public equity and 2/3 private equity. However, the Worldwide Healthcare Trust does represent our largest single fund that we manage at almost 2.4 billion sterling. And you can also see here in this graphic, our sister fund, the Biotech Growth Trust, which, as the name implies, is a pure biotech focused fund that we are also in charge of. Next slide, please. The public equity team, I think, represents a very deep bench of talent with significant academic training, scientific acumen, investment experience, led by the senior managers of the team here at the top, Sven Borho, who I already mentioned, the managing partner at Orbimed, Jeffrey Hsu, who is in charge of the Biotech Growth Trust, our head of trading, Scott Stevens, and myself. You know, Sven likes to talk about our deep bench as a bit of an arms race versus some of our competitors. And I think we've got extremely impressive depth and breadth of personnel, not only across therapeutic stocks and non-therapeutics, as I mentioned previously, medical devices, services, life science tools, diagnostics. But we also have a team on the ground in emerging markets that covers both China and India. I think that's another point of key differentiation for the Worldwide Healthcare Trust. We also have a broad trading and operations team as well, including our Chief Risk Officer, Andrew Kanarick. And we're very proud to announce that a new head of ESG has come on board just late last year, to provide a little bit more skill set in that arena for us as well. Next slide, please. In turn, we're further supported by over 100 colleagues across the globe, which I think we exact really important and significant synergies from throughout the organization. In particular, our private equity team and all the due diligence that they do there across the healthcare horizon. A royalty team, a fixed income team that also contributes importantly. And we also have a very impressive group of venture partners that are brought on board that support our investing efforts in the global equity markets. And they come from industry, they're past CEOs, founders of different companies. And I think collectively, overall, these people really represent the most important asset at Orbimed and one of our key competitive advantages. Next slide, please. This slide gives you a glimpse of some of the processes that really underpin the stock picking at Orbimed. And I don't often present this slide because there's a lot here and I don't want to spend too much time on it. But what I really want to sort of demonstrate here is how much primary due diligence we do across the healthcare universe. One of the biggest things that we do is focus on clinical events, trying to really understand products in the pipeline that are advancing through clinical stage development, from animal testing through to human testing, and hopefully regulatory approval throughout the globe. I think we have a very good ability in predicting and understanding the products in development, but also legal decisions related to drugs. And I apologize for some of the background noise from my computer, but a lot of legal decision work, a lot of work with physician surveys and understanding the practicing physician and what they're focused on. And that works very well with key opinion leaders. If we don't have the expertise in-house, we definitely work with experts across medical fields. We attend almost every important medical meeting that there is, even virtually over the past year and a half. We haven't really missed any. A lot of this then boils down to predicting new drug launches, where we sharpen our pencil and our forecast to try and really understand the potential of some of these drugs as they get approved through regulatory events across US, Europe, and Asia. One other thing I'll just mention on this slide is the importance that we place on our relationships with management teams. I think we, across the healthcare universe, have the most management meetings of any healthcare investor probably in the world. At the end of it, it's truly a bottoms-up analysis of the industry to identify best ideas across the portfolio as best we can. It's really quite interesting. Sometimes I think if you got to sit in one of our portfolio meetings, it might sound more like a doctor's office or an academic lab rather than a financial portfolio meeting. So why invest in healthcare today? Next slide. Well, moving into the next slide yet again, simply put, there's just more of it. There's more patients, there's more innovation, there's more drugs, there's more spending. And let's just step through this a little bit. More coverage. In the US, where insurance really drives utilization, we have more patients under coverage than we ever had before in the US. More globally, there's more elderly patients every year, and we expect that to grow by 1 billion patients by 2050. More income and more patients. And this is an interesting fact I like to put on the slide, that there's 187 million diabetic patients in China and India alone. It's kind of a staggering number. But of course, there's more innovation. And I think this will be a real hallmark of my presentation to you today. We're just simply, quite frankly, seeing more cures, more treatments, more technologies that are bringing forward clinical medicine to an advance that we've never seen before in our history. And it's leading to more drugs. The FDA has approved more drugs over the last 4 years than any time in its history. And these are drugs with real clinical advances. And ultimately, there's more spending. as healthcare spend as a percent of GDP continues to rise. I think that sometimes I hear some pushback on that, but one thing I think is really interesting is the amount of spending that we can forecast within this sector that is going to be insensitive to economic cycles is probably the most predictable of all time. Next slide, please. So with that, let me pivot with a bit of review of performance for the fiscal year that recently just closed for us. And despite some of the tumult and real volatility that we saw in the fiscal year of 2020, we were proud to report both strong absolute and relative returns for the fiscal year that ended for us, which was March 31. And this slide here shows graphically the performance over that fiscal year. So it's important to know when we start and stop. So recall the fiscal year literally started right after the historic drawdown in March of 2020, when the pandemic became, really official on a global basis. This was followed by, recall, that dramatic V-shaped recovery in the equity markets in April, where our fiscal year actually commenced. And we had put together what we called our pandemic playbook at that time, which we instituted, and it worked extremely well, where we focused on looking for extreme dislocations, which were very common in that period. Try to focus on most of our best ideas, reduce some of the name count within the portfolio where possible, try to increase the overall quality of the portfolio, and actually pruning some names that might have been more materially disrupted during this time. I know there was a lot of panic selling. We contributed to some sales, but we tried to be very mindful about that. And this is where we really started to outperform in that fiscal year, which we carried through to year end, extending some of the gains into year end. And I'm proud to say that was one of the best years for the trust in terms of excess return over the benchmark. Next slide, please. So this is an interesting slide because this tries to address, where did this performance come from? And I really think the take home here is that it was broad-based. And this is another hallmark of the Worldwide Healthcare Trust, is the diversity of contribution over time. And this year was extremely emblematic of that. Certainly, our largest subsector contribution came from biotechnology, both some large cap and emerging biotech stocks. But another large contribution came from emerging market stocks, which contributed over 600 basis points of both positive, absolute, and excess return from us. We also had important contributions across pharmaceuticals, specifically specialty pharmaceuticals, where we had a big winner in that particular space in the year, a company called Horizon Pharmaceuticals. Life science tools, also an important contributor. That space was really on fire with all the diagnostic COVID testing that went on. So that really caught a bid during the year. And you can also see a little bit of contribution by geography in this slide, which really just follows the locales where we mostly have important overweight positions in. And I'll discuss that a little bit more in the future. So overall, I'll sort of re-mention this. I just think this slide shows the diversity of our platform and provides investors like yourself with a good option if you want sort of a one-stop shopping for your healthcare exposure within your portfolio. Slide 14 on the next slide is a simple table of the 1, 3, 5, and 10-year returns for the trust. And I think really what this shows is some of the incredible consistency of the returns over the past 25 and now 26 years, not only over the benchmark, but compared to the broader markets, which we've just used the FTSE here as an example of that. Slide 15, I think, shows this much better visually, the performance since inception. And I think this slide shows a couple of things. First of all, just to orient yourself here with the blue lines, which is the Worldwide Healthcare Trust, the NAV and share price versus our benchmark over time. and then the FTSE. And I think the first thing that this slide shows for sure is that exposure to healthcare in your portfolio is really a must. I think the outperformance versus broader market indices over this past decade really coincides with many of the tailwinds that still exist in this industry today, and coincides a lot with the genomic revolution over the past 10 years. And I think the second thing that this slide shows is that an active manager in healthcare can really outperform the benchmark, given the highly idiosyncratic nature of this industry, as I mentioned previously. Clinical medicine and pipeline predictions is a really tough thing to do. So let's pivot now to the next slide and look at the rest of 2021 and discuss some of the investment themes that we're thinking about for the rest of the year and into next year. Next slide, please. And I think everyone is really happy to see, if you could just go back one slide, sorry, Amanda. I think everyone is really happy to see 2020 come to an end, as we would like to do, nothing more than push last year off of a proverbial cliff. I think it was difficult for everyone in so many respects, and it's really changed the world as we know it. And unfortunately, the pandemic has not gone away with the turn of this calendar year, and in some geographies, it's gotten worse, and I still think there remains some uncertainty. So let me start there on the next slide, which I think the one thing that is absolutely clear is that the healthcare's industry response to COVID-19 has been an undisputed success, although unfortunately it's been highly politicized, especially here in the US. But I think the response has been far superior to any single other industry or government response through the pandemic. And just some of the statistics here is just incredible, that over the past year and a half, we've had 400 different diagnostics approved, at least here in the US. Over 600 trials of the vaccines have been registered with the federal registry over the past 18 months. And we've had numerous drugs approved in terms of therapies for the treatment of COVID-19. And what's really incredible to me, I've been monitoring this number since March of last year, where there was maybe 50 clinical trials registered with the FDA for COVID. There's now over 6,500 in the federal registry. I think it's really quite impressive. On the next slide, we have a little bit of a scorecard of the final approvals. 3 novel therapies were approved and each became instant blockbusters, and another one that was just approved a few months ago. We have 3 vaccines that have been approved in the US with efficacy rates that, quite frankly, even surpassed my personal expectations. And I think if you just pause and reflect on this accomplishment over such a short period of time during a real crisis across the globe, it's amazing to me. And I think the key takeaway here is that the industry's response represents a very public snapshot of its incredible innovation. And innovation is what I want to focus on, starting on the next slide. Because our focus, quite frankly, hasn't really been on COVID during this whole period whatsoever. Rather, our focus has been on the totality of innovation across the sector, because I think we're truly living in a golden era of innovation across multiple diseases: diabetes, Alzheimer's disease, cardiovascular disease. Oncology has been an incredible revolution, immunology. And the number of new technologies that we have to create some of these new drugs, whether it's novel biologics, gene editing, the next generation of antibodies, the advent of immunotherapy, which is something I find fascinating. And it's not just therapeutics, but robotic surgery, artificial heart and pancreas, liquid biopsy, I'll discuss a little bit. I think, quite frankly, the move in healthcare over the past 10 years really comes from innovation. And I think that's the #1 value driver for almost all of healthcare. Next slide, please. And I think there are some real interesting examples that I will touch on briefly here, just to give a bit of color of some of the things and some of the themes that we're thinking of that are represented in the portfolio. And I'll try not to go too detailed, but for me, this is the real fascinating part of my job. And what gets me up in the morning is to learn about the next potential big thing that's going to help patients. In this particular slide, this talks about immuno-oncology, and this is a class of drugs that's about 5 or 6 years old, but the science of this class is about 20 years old. And the premise here is quite simple. These are drugs, antibodies, that are used to stimulate your body's own immune system to fight cancer and kill tumor cells within your body. And just over the past 5 years, this market has grown to well in excess of $30 billion, still growing at over 20% per year. And I think this is really an incredible commercial success story. But it's not ending here right now, because many companies who are involved in this particular space of immuno-oncology are now trying to expand the usage of these drugs. And let me explain that a little bit. So far, the approvals are for metastatic stage patients. These are patients who have stage 4 cancer, solid tumors spreading across the body that leaves them with weeks or maybe months to live. And many of these patients, anywhere from 20 to 40%, these new drugs have been cures for those patients. But now the companies are trying to bring these therapies to earlier lines of therapy. Third line, stage 2, frontline therapy, which dramatically increases the patient population if they work in these particular settings of earlier lines. And we're also trying to see these companies use them even before surgery or after surgery in the adjuvant or neoadjuvant settings to help promote cures in these cancer patients. I just finished attending virtually the European Society of Medical Oncology, where we learned that many of these trials are coming up positive. And they're not even finished there, because now we're moving on to next generation targets of immuno-oncology. Beyond the so-called PD-1 target, which is fully established, and you see some other acronyms on here, TIGIT, LAG3, IL-2. These are other new immuno-oncology agents which promise the potential for increased cure rates in the treatment of oncology. This represents almost 20% of the current portfolio of the Worldwide Healthcare Trust. Moving on to my next slide, but sticking in oncology, we're very much onto the next generation of what we call targeted therapies. And basically, this is a form of precision medicine that targets specific cancer-causing mutations. This is really interesting. This is part of the genomic revolution that allows us to identify specific patients with specific mutations and offer a drug that might be beneficial for that patient specifically. This has the potential to offer increased efficacy in those specific patient populations, ideally a little bit more tolerability, because you're not offering a drug to someone who otherwise might not benefit. And again, we've done some recent data at the European Society of Medical Oncology. A company called Mirati showed new data for something called a KRAS inhibitor, which showed impressive efficacy in lung cancer with patients with that specific type of mutation. And roughly 10% of the portfolio is in companies who are developing these types of new targeted therapies. My next slide, I'm going to chat a little bit about liquid biopsy. And this has really been a sort of revolution, if you will, in diagnostics. Liquid biopsy, for those who might be unfamiliar, as sort of the name implies, I guess, it is a way to detect disease from a simple blood draw from a patient rather than a much more invasive tissue sample that has to be sourced and removed from a patient in a more conventional surgical procedure. And this has turned out to have numerous benefits beyond the obvious. Because not only do we get a sample more easier, but that blood, as we've learned over the last 10 years, contains a wealth of information that allows us, or physicians rather, to early detect different diseases, especially some cancers, or other pathologic issues in prenatal detection, allows patients to potentially choose the best course of therapy ahead of time. Liquid biopsy also helps to measure the treatment effect and to monitor the potential for reoccurrence or relapse post-treatment. So there's a few examples here, and roughly 10% of the portfolio is represented in some of these novel liquid biopsy companies. On the next slide, just to move a little bit away from innovation, but not completely, but another key overweight sector for us is in the emerging markets. In here, what's really fascinating is a host of macro tailwinds that are really buoying the healthcare investment opportunity in China. And I think many people are aware of the main one, which is aging demographics and the increased consumption of healthcare in China. But what's really important to note with that is China is probably going to be the fastest growing healthcare market over the next 10 years. And there's also some other factors going on there that is really buoying the investment opportunity. One is the change to the IPO listing rules within China. Previously, a company had to demonstrate historical revenues and earnings to be listed on local exchanges. So by default, you couldn't list a biotech company that had a product in development, but had no particular sales, so no revenue, certainly no profits. And this is a bit of a sweet spot for us at Orbimed, identifying these companies early on and getting in early on the value curve with some of those investment opportunities. So that's exploded for us there. But another sort of key change has been the regulatory environment for new drug approvals. The government there has raised the bar significantly to get a new drug approved. Historically, a very simple dossier would get something approved. Today, you have to be much more sophisticated, and they've really adopted Western styles of drug review to make it much more difficult to get a drug approved there. Well, what does this in turn do? It benefits innovative companies, not only the global multinationals who want to pursue new drug approvals in China, but also the local players, because we've seen a massive inflection point of innovation coming from China itself. And again, this has increased the number of investable targets for us within China. I haven't mentioned much about India, but we also have a team there as well that's also been very productive for us in terms of generating differentiated returns. And typically, emerging market exposure for us ranges between 10 and 20%, typically in the mid-teens, just depending on various conviction levels and current volatility in the market. Moving to slide 25, I'm going to pivot a little bit because this is an important theme, but it's politics. And I apologize in advance. I hate discussing politics. I'm a scientist, but unfortunately, politics can play a big role in the healthcare space. And earlier this past January, I produced a video for the Worldwide Healthcare Trust website after the Georgia state runoff elections that completed the recent US presidential election cycle. And I'll try not to go into details, but that was an important runoff because the impact of those two Senate seats, which were Republican incumbents, unexpectedly went to the Democrats. And the result of that is full Democratic control of the US federal government, from the White House to all of Congress, which is the Senate and the House. And that created a bit of a headwind and an overhang to the space because of the concerns that the Democrats, now in full control, were going to do and try and pass some egregious legislation that would hurt the healthcare space, in particular therapeutic names, pharma and biotech. But the point of this slide here is that even though the Democrats did sweep this election, they did so by the very smallest of margins, making it very difficult, I think impossible almost, at least politically, for this administration to really pass any egregious or controversial legislation. And the reason I highlight this topic because it's back in the headlines, and they can't prevent the headlines. This thin majority, the headlines are going to come. Biden's again talking about some sort of drug price reform, and the Democrats are trying to pass some form of drug pricing reform through the House and Senate. And optically, it can sound very scary, but I do not think it's going to happen. And we've already seen some moderate Democrats crossing the line on that. If you can see on the next slide, this has kept a little bit of lid on relative valuation for the broader healthcare sector. I think this is another key reason to invest in healthcare right now is, quite frankly, valuation. And this is a long chart that goes back to the early 90s, but it shows basically, let me scene set it for you, which is the S&P healthcare subsector discount or premium versus just the broad S&P 500. And this chart shows we're trading at historical lows. And I quite frankly think one of the main reasons, not the only reason, but these generalist investor concerns over material drug price reforms in the US. And this is very similar to what we saw in the early 90s with Bill Clinton and concerns over reform at that point. And then when Barack Obama took over office, we also experienced those same concerns, and we saw the contraction of valuation during those times, which I expect that discount to eventually to reverse. So what do we expect from a Biden presidency? That's detailed on this next slide. But first and foremost, healthcare has not been his #1 priority. Clearly, when he took office, the focus was on the economy, the pandemic, stimulus packages, infrastructure, a lot of discussion about tax reform. Healthcare as a broad platform was not really a talking point. COVID certainly was a key talking point for him in terms of, again, COVID stimulus package, further fostering the vaccine distribution, Medicaid funding, which actually is positive for the space, but how he was going to fight the pandemic and other lockdown masking considerations. Healthcare, #3, the focus there will be on the Affordable Care Act. And this is super important, just as a reminder. I know it's slightly obvious, but recall, Biden was the vice president under Obama, and Obamacare, which is the Affordable Care Act, that's part of Biden's legacy. He's looking to expand on it, not fundamentally overhaul it. That reduces the risk of egregious legislation being passed going forward, which is #4. And once again, that very narrow margin of victory, I think, makes it very difficult for any egregious legislation to be passed. So I think it's a very low probability event. But finally, on point 5, I think something will get done on drug pricing. We expect some form of reform to be passed. In conjunction with the pharmaceutical industry, the biotech industry, that'll be mostly benign for the biopharma industry, but importantly, will have the effect of reducing out-of-pocket expense on seniors, Medicare, and Medicaid patients. And if this culminates in the way I think it will, this could actually be a clearing event for the sector, which will help re-rate that valuation higher than where we're seeing it today. Next slide, please. So some other key drivers for 2021. This slide contains 4 different important quadrants. 1, deep therapeutic pipelines. This is, again, just another scorecard of innovation, if you will, that the pipelines of these companies across the globe are deep and they're as full as they've ever been. And again, as I mentioned this previously, this is leading to record new drug approvals. M&A is always a theme for us in the Worldwide Healthcare Trust. There's a bit of a natural ebb and flow to it as it relates to the capital markets. Sometimes when the capital markets money dries up a bit, M&A goes up. When the IPO market heats up, M&A seems to go down. COVID had a bit of a different effect. There was a lot of sort of wait and see throughout the period, but we saw an acceleration into the year end in M&A. But then as we flipped into the calendar year, it started to slow down again as concerns about drug price reform, the recovery trade, What was happening with vaccines, that's slowed down things a little bit on the M&A front. But we're expecting that to increase a little bit. We start to see a few more deals here now in the third quarter, and some rumored deals that we hope to happen soon. That has a tendency to reinvigorate the biotech space significantly. And then finally on this slide, focusing on catalysts. This is something that we do all the time, and I've mentioned it previously, but the clinical catalysts, we do a lot of work there. Regulatory catalysts, trying to understand where drugs are going to get approved, and quite frankly, where they're not going to get approved. And then financially, looking at the P&L of these companies, trying to understand valuations appropriately, the new drug forecasts, and really understanding prescription trends across the globe as new drugs roll out and get taken up by patients globally. Let me pivot now to the next slide. I'm going to move to discuss a little bit of the portfolio. And as you can see here, we manage a truly pan-healthcare trust, but we do have some strategic components to our sector weightings that are highlighted here in the red and green boxes. Our key underweight rather, remains large cap pharmaceuticals. And this is quite frankly for a few reasons. First, it's a nod to the benchmark. The benchmark is anywhere from 35 to 50% large cap pharma, depending on exactly how you want to define it. And this is a very heterogeneous group of companies with many haves and have-nots, from their new product flow, from their current growth rates, their pipeline opportunities, their history of business development, how we feel about their management teams. So we remain very selective in this space, and we have traditionally, although more recently we have increased our exposure there. Also importantly, this allows us, this underweight strategic tactical move allows us to fund other areas which we are more bullish. So one key overweight for us is small cap biotechnology. And you can see here the benchmark weight is under 5%. So that's another reason for the key overweight, a nod to the benchmark being quite small in this particular space. But as I tried to communicate through my presentation today, this is really the cradle of innovation in the therapeutic space. These small entrepreneurial companies with technology platforms and lead assets are really the key for innovation. And typically, and I'm not trying to dismiss the efforts of the larger companies because they're contributing as well in a significant manner. But where they have holes in their pipeline, they go to the equity markets and look for these types of companies for acquisition. And then the third thing I'll point out here from a strategic overweight is emerging markets, as I discussed in the previous slide. And you can see here we're currently at 14% overweight. We were recently a little bit higher, but a little bit of turbulence in emerging markets over the last couple of months. Which brings me to a couple of my final slides on slide 31. So first here on mid-cap biotech. So, this slide shows the XBI. This is an ETF that we look at that represents nearly 200 different emerging biotech companies compared to the broad market. So we like to look at the XBI as sort of an index, if you will, for emerging biotech stocks. And you can see the dramatic underperformance versus the S&P since the middle of February. And this has been a very material drawdown. And there's been a host of reasons for this. I think the biggest two has just been the factor trade, where we've seen a rotation out of growth into value. It's been really significant. I also think it's just a bit of product of profit taking. I mean, the XBI was up 50% last year, sort of under the halo of COVID. It did extremely well, and we see that reversing a little bit. But also, the other factors have been this continued broader market recovery trade. I think the vaccine data was so good, everything else became a buy at the turn of the calendar year. And quite frankly, we've had a little bit of sparsity of clinical catalysts. and even some negative catalysts in the space. M&A has been a little quiet for the first half of the year that I mentioned. And of course, that drug price reform, which is an overhang that I think will ideally lift before year end if our US politicians can get their ducks in a row there. And then secondly, on slide 32, a comment on emerging markets. This is a shorter time period, just over the last couple of months, but in emerging markets, there's been some really tough headlines over there about government intervention into various industries that has really spooked investors, causing yet another set-off, partially sort of broad market, but specifically in healthcare. And this graph shows the Hang Seng Healthcare Index just versus our benchmark, and we've seen some material underperformance here. But this is where we think the market has really got it wrong, especially the generalist investor, that generalist institutional investor. While the worry over drug pricing and pressure in China is also real, there's nothing new that the government has tabled there. In fact, we think the market is misreading it, that the Chinese government has made improving healthcare a real priority there. And we have learned a bit of a golden rule that it is always best to at least try to invest along with government policy in China rather than against it. And I think there's a concern by investors that the Chinese government has made a move against healthcare. But rather, I think it's just the opposite. They're fostering better healthcare choices for their citizens there. They're increasing the level of innovation. And like I mentioned previously, they're totally behind creating a new biotechnology industry in which they've done a very admirable job, even though it's still in a rather nascent period. So I think overall, these two examples, while they've created a little bit of headwinds for the trust, I think creates an interesting buy opportunity given our current positioning sort of going forward. I think I have one more slide left, and this is just a very brief playbook, just summary for you to sort of take home with. It's a bit repetitive, but just to remind you of the hallmarks of my discussion today. You know, we are going to continue to monitor the pandemic. It's still influencing markets, you know, whether it's infection rates, variants, what's going on in the hospitals, and certainly the vaccine debate is raging on now that we move to boosters and the debate there. Innovation will continue to be our focus across as many sectors where we think there's innovation that's really booming. We want to capitalize on the recent disruption of the emerging markets. We think that's an opportunity. And then numbers 4 and 5 are a couple of things I really didn't discuss much in my presentation just due to time, but we do use gearing within the trust, trying to use it a little bit more tactically and levered up and down when we see more material disruptions in the marketplace. And we've also tried to increase investments in unquoteds, a few more private investments, some crossover opportunities, ideally with near-term liquidity events. But we've tried to introduce a little bit more flavor into the portfolio early on in the investment opportunity and value cycle. And then finally, I mentioned this with M&A, but we're expecting / hoping for some M&A to lift into year end. And so my final point here at the bottom of the slide, we are very bullish given the outlook, given the current relative valuations that we're seeing right now, the recent drawdowns that we've seen in a couple of the sectors, and the overall innovation in the space. So with that, I will pause and hand it back to Mark for a little bit of Q&A.
Thanks very much, Trevor. That was a very interesting presentation. And I think with your final comments there, you've pretty much answered the first question, which was whether, given the drawdown in biotech, you've been increasing your exposure to that subsector.
Yes, so we have been increasing our allocation to that subsector, but you know, it's always very difficult to do the true double down. You always have to keep a little bit of powder dry, because the one thing that we're not, Mark, is we're not market timers. That is not our goal with the trust. Our long-term success has really been focusing on what we think we're good at. Like I mentioned, I sit around my office with other PhDs, MDs, industry professionals, and I think we're really good identifying the innovation within the space. And we try and be patient with that. And sometimes the market doesn't share our patience and will sell biotech somewhat indiscriminately. But certainly we've been adding, and we think it's due for an inflection point.
Thank you. George asks, worldwide healthcare is invested some 16% in Greater Asia, most in emerging markets. Do you see this as a growing trend?
Well, certainly our focus on it is a growing trend. Whether I take that question more literally, in other words, are we going to be growing our exposure there? No, I think we're going to keep it within that 10 to 20% window, typically be in the teens, but try and be a little bit tactical within that space as different ideas are introduced to the portfolio. Sometimes there's time when we do some profit taking and exposure will come down. Sometimes we'll be trying to add in a period of volatility, or sometimes we see extreme dislocations over like the last 2 months, and sometimes you're running to stand still a little bit when that happens. But no, this is an important priority for us moving forward for sure.
Thank you. Lillian asks a couple of questions about geographies. I'll sort of group those together. So firstly, about the UK. Do you see many good investments in the UK, good UK companies in the healthcare space? And then there's a similar question relating to India. Again, do you see much good innovation coming out of India?
Sure. So, you know, the thing about the UK is historically, one of the things that we try to offer with the Worldwide Healthcare Trust is we try to offer UK investors an alternative to UK located companies. You know, sometimes it's very easy to sort of, and I'm oversimplifying, but to pick a Glaxo or pick an AstraZeneca being in the UK, and that's your exposure to healthcare. So we've tried to provide an alternative to that. We don't discriminate against UK companies, but that hasn't been our primary focus. That being said, the dirty little secret right now in the trust is we've dramatically increased our exposure to AstraZeneca. And quite frankly, it's one of our top ideas right now. And I know the company and the CEO has been under intense scrutiny over the past 6 months, well, maybe 12 months now, over their handling of their own vaccine and the relationship with Oxford. But what that sort of controversy has masked is one of the most incredible turns around in terms of pipeline and new product opportunity that we've ever seen. And when the volatility arrives in the stock, the valuation come down to a very interesting entry point for us. So we've added to our position over the past number of months, but even more recently, the news flow out of the pipeline has all been very positive. And I think there's a real interesting opportunity moving forward for AstraZeneca. So typically, I wouldn't lead with Astra as a great UK idea, not because it's not a good company, but just be mindful we're trying to offer you alternatives, but sometimes we just can't say no.
Quite, yes. I mean,
sorry.
I've been an investor in AstraZeneca myself since slightly before Pascal came on board. And when I saw him switching from buying back his company's shares to investing in R&D, I significantly increased my holding at that point, and he's certainly done an incredible job since coming on board some 7 or 8 years ago now. Yeah,
it's a really incredible period of time, because I think it was almost 10 years where Astra was unable to show any material growth whatsoever. So it was very easy to not give Pascal the benefit of the doubt when he came on board. So bravo.
Certainly a risk.
Yeah. Yes. I think Lillian's other part of the question was India.
India, yes. Yeah.
So one of the names I would throw out there, and I'm always loath to just provide a single name idea, because it takes a little bit away from the quality of my teammates that are there on the ground, who are doing a very impressive job at scanning a very large universe of companies. But one of the companies that we've been interested in over the past year or so was Apollo Hospitals. And this is a large hospital company with many hospitals across India. And it's kind of interesting because, this is one of those things, I'll be honest, Mark, sometimes there's that old saying, you got to be good to be lucky, but lucky to be good. So we got into Apollo Hospitals. It was identified by our team in India. And one of the things that they were doing, they were bringing in new technologies that would be commonplace in Western hospitals, like some of the new MRI technology, PET scan technology, which might not be common in some of those hospitals. And they were bringing in, through capital expenditure, some new equipment, and that was drawing new patients into those hospitals and creating a revenue inflection. But then COVID happened. There was a little bit of volatility there, and that actually became sort of a boon to them, if you will, as in some hospitals in different locales, the COVID patients become very unprofitable. But India, it provided an important tailwind. So it wasn't really part of our thesis, but what was in the portfolio, and we were able to capitalize significantly on that stock. And they've done a lot of smart management moves till then. They just reported their quarter. Last month, there was a little bit of profit taking over the last few days in that name, but that's a name that I would highlight, Apollo.
Thank you. Stephen asks a very interesting question. However one might strive to keep up, it's impossible to come close to the deep understanding of the experts in each of the many subsectors of biomedical research. And each of these super specialists tend to have vested interests in their own ideas. So how do you avoid being dazzled by the apparent promise of new ideas presented to you?
Wow, Stephen, that is a great question because I completely agree with the premise. Because there's really two parts to that. The first part, it is really hard to keep up. It's easy for me to sit here and tell you how great the innovation it is in this sector, but to be able to keep up, to try and understand it, to try and be that one step ahead, to try and understand what the next big thing is a real problem. And that's where we struggle. And as an example, and I might be putting the cart before the horse, but the current head of R&D at Eli Lilly, very successful academic. He has spent his career studying the amyloid hypothesis, which is a critical set of assumptions around Alzheimer's disease. Lilly has re-rated significantly this year on the promise that they have the next big thing in Alzheimer's disease. We're not so sure. And this is an example of a real champion within that organization, a person who has spent his career studying this. They have a small but important phase 2 study that shows a signal. He thinks they have a drug. They're going to file it with the FDA soon before they have the actual final registrational data. So again, that's maybe a bit of a cart before the horse. So in this case, we have taken a cautious approach, a more conservative approach to that investment because we think it's prudent. We don't think the science is quite there. And of course, when you layer on the lateral controversy around Biogen and their Alzheimer's drug that they've gotten approved by the FDA, despite the protest of many key opinion leaders that drug should not have been approved, given the failed trial that supported that approval, we have to be very cautious. But it continues. There are so many investable assets out there. There's actually probably not quite enough expertise, meaning I wish I had a larger peer group, a larger group of colleagues, because there is just so many investable assets out there. But I guess it's what you call a high-class problem.
Yes, definitely, as you say, so many ideas. But then it leads to pitfalls, as Stephen asks, a supplementary. What have you bought that has turned out to be snake oil? So yeah, well, it's worth declaring one's mistakes.
Yes, and that goes back to that idiosyncratic risk and the idiosyncratic nature of being a healthcare investor, especially in the biopharmaceutical space. What we try to do to manage that risk is look at things like conviction level and potential payout. What I mean by that is we try and probability adjust our confidence that something will be positive or negative after an important data readout. But then we also try and measure, well, what is the upside, downside for the stock if that is the eventual result? So what we try and do, and I'm oversimplifying it because there's a lot of work that goes behind it. What we try and do is we try and pick events or drugs that we think are going to be positive with high conviction that have a greater than a 50% payout, if you will, more than 50% upside. So in doing so, even if you're average at this, and let's call average, you get half of them right and half of them wrong, my payouts should still be bigger than my losers if I avoid my low conviction ideas with lower payout options and I bet more on my high conviction ideas with high payout options. Again, I'm oversimplifying it. But look, we have plenty of losers. I have to be very humble. One of them, and this really doesn't fit with that question, but I will be honest. We got very concerned about the valuation of some of the COVID vaccine companies, specifically Moderna and BioNTech. And the valuations, we never fully understood, and they just kept getting higher and higher and higher. And I know some of the sales figures seem incredible, but we did miss that. We felt it was inappropriate for us to be involved in stocks that we felt that were overvalued, in which the recurring revenue stream was going to be extremely limited. And then, those stocks became a little bit like Tesla. And we just felt sort of fiduciary responsibility, it was inappropriate to be there. So that wasn't not so much that we missed it scientifically, but a valuation move that we couldn't just support following.
Thanks very much, Trevor. I think that's probably reached the end of your availability now, I understand. There are a few more questions outstanding. Would it be okay if Amanda emails those to you and perhaps you could have a look at them offline? Sure,
that would be great. Thank you, Mark. I appreciate that.
Amanda will do that. Thanks very much, Trevor. It's great to see you, and thanks for a very interesting presentation.
Thanks, Mark, for hosting, and thanks for everyone on the call. I do appreciate your time, and maybe we can do this again next year.
Yeah, very much look forward to that. Thank you, Trevor.
Cheers, everyone.